A single Bitcoin is worth 42 Federal Reserve notes right now. Not dollars, Federal Reserve notes. That distinction matters, and in about 12 minutes, you'll understand why it matters more than anything else happening on your screen. But here's what's strange. That same Bitcoin, priced against the M2 money supply, the actual quantity of dollars in existence, is worth something entirely different. When you measure Bitcoin not in nominal dollars but in purchasing power, adjusted for monetary expansion since 2020, the number you get is $847,000. Not $42,000. $847,000. That's not a price prediction. That's a measurement of how much the denominator has been diluted while you weren't looking. 72 hours ago, American Special Forces crossed the 38th parallel. Kim Jong-un is in custody at a location the Pentagon won't confirm. Pyongyang is under military administration. The Hermit Kingdom, after 70 years of isolation, has fallen in less than 3 days. And while every network covers the military operation, while analysts debate reunification timelines and nuclear security, something far more significant is happening in the financial system, something the Bitcoin ratio just revealed. The Federal Reserve is experiencing a settlement failure, not a policy error, not a liquidity crunch, a structural failure in the mechanism that allows the entire system to function. This is not about North Korea. North Korea is the distraction. This is about what happens when the last buyer of American debt disappears at the exact moment the system needs them most. Here's what they're not telling you. At 4:47 a.m. Eastern on January 21st, 6 hours before the first reports of military action in Pyongyang, the Federal Reserve Bank of New York executed an emergency reverse repo operation. Not the routine overnight operations you see reported. An emergency injection of $214 billion into primary dealer accounts, with settlement terms of 6 hours instead of the standard overnight window. 6-hour settlement. That term hasn't been used since September 2019, when the repo market seized and overnight rates spiked to 10%. It indicates one thing: someone couldn't meet their obligations, and the consequences of default were catastrophic enough to require immediate intervention. The official explanation, when there is one, and there hasn't been yet, will involve technical factors, routine liquidity management, nothing to worry about. But the data shows something far more mechanical. 3 of the 4 largest foreign holders of U.S. Treasuries executed sell orders in the 72 hours preceding the North Korea operation. Japan, China, the United Kingdom. Combined selling of $340 billion in Treasury securities, concentrated in the 2-year to 10-year maturity range. This wasn't portfolio rebalancing. This was coordinated liquidation. And it happened before any public indication that military action was imminent. Someone knew. And whoever knew decided to exit dollar assets before the consequences became undeniable. The Bitcoin ratio reveals what the nominal price conceals. This is the mechanism you need to understand. Bitcoin's supply is fixed at 21 million coins. That number doesn't change based on policy decisions, emergency interventions, or geopolitical crises. It's mathematics, enforced by code, verified by every node on the network. The dollar supply is whatever the Federal Reserve says it is. Since January 2020, M2 has expanded from $15.4 trillion to $21.8 trillion. That's a 42% increase in the quantity of dollars chasing the same goods and services. The official inflation statistics capture some of this. The 9.1% peak in 2022, the transitory period that lasted 2 years. But the real dilution is larger than any government statistic acknowledges. When you divide Bitcoin's fixed supply by the ever-expanding dollar supply, you get a ratio. That ratio has been climbing steadily since 2009, but in the last 72 hours it's done something it's never done before. It's gone vertical. Not gradually vertical. Instantaneous. The kind of move that indicates not organic buying but a fundamental break in the relationship between the numerator and denominator. At 11:23 p.m. Eastern on January 20th, while cruise missiles were still in flight toward North Korean air defenses, the Bitcoin to M2 ratio breached its previous all-time high by 34%. In 4 hours. That's not retail buying. That's not institutional allocation. That's a system failure expressing itself through the one asset class that can't be diluted by central bank intervention. This is where the lie becomes unsustainable. The Treasury market requires constant demand to function. Every week, the United States government auctions hundreds of billions in new debt to cover maturing obligations and fund the deficit. These auctions require buyers. Without buyers, rates spike. With spiking rates, interest payments explode. With exploding interest payments, the deficit widens. With a wider deficit, more auctions are needed. More auctions require more buyers. It's a perpetual motion machine that only works as long as someone keeps feeding it. For decades, that someone was foreign central banks. Japan accumulated $1.1 trillion in treasuries. China peaked at $1.3 trillion. Together with the UK, Belgium, Luxembourg, and the Cayman Islands, the latter three being mostly financial intermediaries for larger holders, foreign entities owned over $7.6 trillion in American government debt. That number peaked in October 2024. It has declined every month since. Not dramatically, a few billion here, a few billion there, but the trajectory is clear, and the North Korea operation just accelerated it. Why would foreign central banks sell treasuries because the United States captured Kim Jong-un? The answer isn't about North Korea at all. It's about what comes next. Every military operation costs money. The Iraq War, $2 trillion. Afghanistan, $2.3 trillion. The current projection for North Korean stabilization, reconstruction, occupation forces, nuclear security, humanitarian assistance, starts at $1.5 trillion and scales from there. That money has to come from somewhere, and the only somewhere available is more treasury issuance, more debt, more supply flooding into a market where demand is already retreating. Japan has its own problems, a currency crisis that's consumed the Bank of Japan's attention for 18 months. China is actively building dollar alternatives. The UK is managing a fiscal crisis of its own. The natural buyers are becoming sellers at the exact moment the supply is about to surge. When institutions do what the Fed did at 4:47 a.m., emergency 6-hour repo operations without public announcement, they're not managing risk. They're preventing immediate collapse. The last time the Treasury market experienced this kind of supply-demand imbalance was March 2020. The solution then was $4 trillion in Federal Reserve purchases, direct monetization that expanded the central bank's balance sheet to $8.9 trillion. The problem with that solution is that it's already been used. The Fed's balance sheet, despite 18 months of quantitative tightening, still sits at $7.4 trillion. They've been trying to reduce it, selling $60 billion per month, letting securities mature without reinvestment. The strategy requires stable markets and willing private buyers to absorb what the Fed is no longer purchasing. North Korea just eliminated that stability. Less than 48 hours remain before the first post-invasion Treasury auction, $50 billion in 3-year notes. The market is already pricing in a 47 basis point tail, meaning buyers are demanding nearly 0.5% more yield than indicated pricing suggested. That's not a normal auction. That's a buyer's strike in slow motion. If the auction fails, if there aren't sufficient bids to cover the offering, the Fed has only two choices. Let rates spike, triggering a cascade of margin calls across the $26 trillion Treasury market. Or resume purchases, abandoning the inflation fight and confirming that the United States government can only fund itself through direct money printing. The Bitcoin ratio is pricing in option 2. That vertical move isn't speculation about cryptocurrency adoption. It's the market calculating what happens to a fixed supply asset when an unlimited supply currency faces a printing imperative. While one side prints, the other side takes possession. The geopolitical dimension of this crisis extends far beyond the Korean peninsula. China's immediate response to the invasion was not military. It was financial. Within hours of confirmed American boots on the ground in Pyongyang, the People's Bank of China announced acceleration of its sovereign settlement protocol with Russia, the same framework established 3 weeks ago for de-dollarized trade. The announcement specifically mentioned defensive measures to protect against unilateral monetary actions by hostile powers. Unilateral monetary actions. That's central bank language for what they expect the Fed to do. Print. Russia followed within hours. The Moscow exchange suspended dollar-ruble trading for technical maintenance that no one believes is actually technical. Gazprom Bank, Russia's primary energy settlement institution, announced immediate conversion of all dollar-denominated receivables into yuan and gold. Rosneft began quoting crude oil contracts exclusively in rubles for new customers. These aren't reactions to North Korea. They're reactions to what North Korea implies, that the United States will spend whatever it takes to maintain military hegemony, regardless of the fiscal consequences. And spending whatever it takes means printing whatever is necessary. The BRICS response has been equally illuminating. Within 36 hours of the invasion, emergency consultations convened between finance ministers of China, Russia, India, Brazil, and South Africa. The joint statement, released without a press conference, posted only in Mandarin, Hindi, and Russian, referenced unsustainable dollar expansion and accelerated implementation of alternative settlement mechanisms. Saudi Arabia, the linchpin of the petrodollar system since 1974, has remained silent. That silence is more significant than any statement. The Saudis don't do silence. They issue statements, make calls, participate in frameworks. Silence means they're calculating. And what they're calculating is whether the American military victory in North Korea will be paired with monetary defeat everywhere else. The trap closes from multiple directions simultaneously. The Federal Reserve cannot raise rates. The debt service costs would consume the entire federal budget within 3 years at 6% yields. They cannot cut rates. Inflation, while moderated from its peak, remains above target and would reignite with monetary easing. They cannot maintain current policy. The Treasury market requires either massive Fed purchases or massive foreign buying, and the latter is disappearing. Every path leads to the same destination: more dollars. More dollars means higher Bitcoin ratio. Higher Bitcoin ratio means accelerating flight from dollar assets. Accelerating flight means more pressure on Treasury auctions. More pressure means more Fed intervention. More intervention means more dollars. It's a spiral that can only end one way. The only question is timing. This is what a system looks like when the math stops working. $34 trillion in federal debt, $1.2 trillion in annual interest payments, $2 trillion in annual deficit, $7.4 trillion in Fed balance sheet, and now, a military occupation that will require $1.5 trillion or more in new spending over the next decade. The numbers cannot be reconciled through conventional means. They can only be reconciled through currency devaluation, making the debt smaller by making the dollars it's denominated in worth less. Bitcoin is the measurement device. Not because cryptocurrency has magical properties, but because its supply constraint makes it a fixed reference point against which monetary expansion can be measured. When the ratio goes vertical, it's not Bitcoin becoming worth more, it's dollars becoming worth less at a rate faster than official statistics acknowledge. The informed are not buying Bitcoin because they believe in technological revolution. They're buying it because they understand accounting. Specifically, they understand that liabilities denominated in a currency you can print are very different from liabilities denominated in something you cannot. The United States has unlimited liabilities, and the unlimited ability to print the currency those liabilities are denominated in. Every foreign holder of those dollars understands what that combination means. The $340 billion in pre-invasion selling wasn't panic. It was mathematics. What happens next is not prediction. It's observation of processes already in motion. The Treasury auction in 48 hours will either succeed with massive Fed support or fail publicly. Either outcome accelerates the dynamic. Success proves the Fed cannot exit. Failure proves the market cannot absorb supply. Both paths lead to more printing. The Bitcoin ratio will continue to reveal what nominal prices obscure, the true rate of monetary expansion, measured against something that cannot be expanded. That measurement will become increasingly difficult to ignore as the gap between official statistics and lived experience widens. The geopolitical realignment will accelerate. Every nation watching North Korea is running the same calculation. American military power remains formidable, but the currency that funds it is on a terminal trajectory. The rational response is to reduce exposure while the reduction is still possible. Gold is moving. 127 metric tons have changed hands on the Shanghai Exchange since the invasion began, the highest 72-hour volume in the exchange's history. Physical premiums in Singapore, Dubai, and Mumbai are running 5 to 8% above paper prices. The divergence between paper claims and physical possession is widening exactly as it does in every late-stage currency crisis. But this crisis is different in one critical respect. Previous currency crises happened at the periphery: Argentina, Turkey, Venezuela. This one is happening at the center. The dollar is the denominator in which all other currencies are measured. When the denominator itself becomes unstable, there is nowhere to hide within the traditional system, only outside of it. Reality does not care about narratives. It does not care about military victories or political calculations or expert analysis. It cares about numbers, about the relationship between assets and liabilities, about the difference between promises and physical reality. The North Korean regime survived for 70 years by making itself too dangerous to confront. 3 days ago, that calculation changed. 70 years of isolation ended in 72 hours. The dollar system has survived for 80 years by making itself too essential to abandon. That calculation is changing now. Not in 3 days. These things take longer. But the Bitcoin ratio, that simple division of fixed supply by expanding supply, just told us something that headlines won't admit for months. The emergency has already begun. The question is not whether the system fails, but who understands the failure while there's still time to position for what comes after. The ratio doesn't lie. It can't. Mathematics has no agenda. $42,000 on your screen. 847,000 in purchasing power terms. The gap between those numbers is the gap between what you're told and what's actually happening. Kim Jong-un is in custody. The Federal Reserve is in crisis. And the measurement device that cannot be manipulated just went vertical. Reality is asserting itself. It always does. The only question is who sees it clearly before the adjustment becomes impossible to ignore.